Okay, good evening everyone. Welcome to the session. The course is Introduction to Accounting and Finance for Civil Engineers by Professor Sudhir Mishra and Professor K. Jha. I am Venugopal Mahajan. We'll be discussing week 3 contents. So, in this session, the main topics that were discussed were break-even analysis and depreciation. This is a live interactive session, so I request all of you to please participate. It would be better if you keep answering, go with the flow, and it also if you solve together. So coming to the first question, RMC company sells concrete for a price of rupees 3,500 per meter cube. The fixed cost for the production is rupees 40,000 per month and the variable cost associated is rupees 1,500 per month. What is the break-even quantity of concrete? Fairly straightforward problem. We need to calculate the break-even quantity. Now, what is break-even quantity? Okay, so total cost is indirect cost plus direct cost, right? Direct cost that you can link to your product. I mean, if let's say you are producing n number of units, then direct cost becomes n into direct cost of one unit. And indirect cost is kind of fixed charges or those charges that you can't quite attach to per unit, and this will be there even if there is 0 unit production. So if this is your total cost, but so what is the break-even quantity? Break-even quantity is where your total cost is equal to your total selling, so that your profit is 0 but you are not in loss. So in this case, you have been given that you are selling it for rupees 3,500 per meter cube, while variable cost is rupees 1,500 and the fixed cost is 40,000. So this kind of brings the total cost as 40,000 plus n into 15,000, n into 1,500. This is the total cost, and the price you will be earning for this is n into 3,500. So for P minus TC is equal to 0, we get n is equal to 40,000 divided by 3,500 minus 1,500. In this is equal to 20. So this kind of gives us our answer, but let's backtrack a little. So this n here is break-even quantity. It is given by indirect cost divided by the price of one unit minus unit direct cost. Okay, and this whole fraction is called contribution, as covered in the lectures. I hope you are following till here.
Yeah.
So this is the kind of graph we get. Why straight line? I mean, we'll follow step by step. 0, 40,000. So anyway, if you start production of even one unit, you will have indirect cost of, fixed cost of 40,000, and from there you get this line, total cost line, 40,000 plus 1,500x, and revenue for each product we have got 3,500x. So this kind of gives us, TC minus R is equal to 0. This gives us our break-even point. We have quantity on the x-axis. So if you are in this region 0 to B, you will be making some loss. If you have more than B, you will be gaining profit. Now this graph you can plot it. This is fairly linear. My question to you is, can there be curves in this case? Yes, there can be. It is not necessary that you get such fairly straightforward linear equations, because the unit direct cost also depends on many factors, and it can also increase on or decrease depending on other variables. Now, coming to these questions, these are the theoretical questions that were asked in previous assignments. So, please, I'll please help me answer these. Consider the following statements. Break-even analysis is another way of performing sensitivity analysis. Break-even analysis helps in making decisions such as whether a product should be produced or bought, or whether an equipment should be bought or rented. So, what do you think? Which of the above statements are correct?
Statement 2 is correct, I think.
Statement 2 is correct.
Yes.
And what about statement 1?
That I got. I'm not sure about that.
Yeah. Okay. We discussed sensitivity analysis in the last lecture, right? Last session.
Yeah. Yes, yes.
So, in case of sensitivity analysis, you knew we were checking that if we were increasing our uh, any value like present worth or its salvage or annual cost, we were checking how it affects our NPV, right? In
Yes, yes.
in break-even analysis also, we are kind of doing the same thing, because we are varying our quantity n and checking what is the net present worth with some cost and some benefits coming in. So it is also it is also a way of performing sensitivity analysis, but you can also think of it in terms of this way, that in last session we were just interested in what was the rate. If one value increases, does the other increase or remain same or decreases? In break-even analysis, we are quite interested in what happens or at what point that does our decision change. Like, going back to this graph, if the quantity of production is somewhere here, so you will say okay, go for it. But if our quantity of production was less than b, you would have said no, don't move forward, it will give you loss. So yes, we are doing sensitivity analysis, but in this case we are also interested, and our decision can change on the basis of this. So that means the first statement is also true, and second, yeah, as you said that it helps in making decision, we discussed this. So yeah, this is also true. So both are true. Coming to the next part, consider the following statements in context of break-even analysis. The companies try to lower the break-even point by reducing sales price, and the companies try to lower the break-even point by reducing the total cost of production. Which of the above statements are correct? I guess we saw the formula for break-even analysis as indirect cost by production minus UDC. So total cost of production, yes, if you reduce the total cost of production, it will lower your break-even point. But if you are reducing your sales, if P is increasing, B will increase. So this is false. So second is true. Coming to the next question in similar frame, consider the following statements in context of break-even analysis. The point of intersection of indirect cost line and revenue line is known as break-even point. The company would be making profit if its sales are above the break-even point. We saw both of these things in the graph, right? I mean, the intersection point and making profit if its sales are above the break-even point. So both are true. Okay, so this was very brief on break-even analysis. Do you have any questions related to this part? Break-even analysis or marginal cost?
So I think the question on the assignment was break-even analysis.
Yeah. So, what exact problem do you have? I mean, is there some, is there something missing in that part?
So actually, I'm not understanding the question. See,
Oh,
both the questions. First
uh,
time I'm seeing that questions. That's why I'm asking.
uh, okay.
So some equations are given that in question.
Okay, some
So
equations are given. Okay. Uh,
if you open that assignment, that
yeah, just a moment. Actually, it is showing that the site is temporarily down. Okay, so let me get to your problem. In this case, you saw right that total cost is 40,000 plus 1500x and revenue is 3500x. Right. So if you were to calculate the profit, it would have been R minus TC, and this would have been an equation in terms of x, right? Similarly, if you are given just the cost is again in terms of indirect cost plus direct cost, that is again in terms of x. So what can happen is that here we have quite linear equation. It can be uh, it can be of any value, right? I mean, it can be squared, it can be under root or any power or with multiple terms. So if you have to calculate that what is the cost for first unit, you will say it's 40,000 plus 1500. I mean, x is equal to 1. So 41,500. Cost for second unit, now you will say that this cost is actually, if for first unit you have already spent this, and cost for 2 units is 40,000 plus 3,000, that to 43,000, right? So this becomes actually the marginal cost. So marginal cost for second unit is total cost for that unit minus total cost of production till the previous unit. So similar, in the similar vein, you can get the questions there. So marginal cost for second unit would have been 1500, and that also you can calculate just if you have been given total cost. If you differentiate it, it will give you the change in total cost per unit. I mean, if you have got TC, so change in TC per unit uh, per new unit would give you your marginal cost, right? In this case, it's 1500. So I guess similar question has been framed there also, right?
yes, sir. Question was similar.
So only change would have been the powers.
Yeah,
So
but
yeah,
for marginal cost, what we have to do? We have to take derivative of total cost, or like the previous one that you have done. Like we have to put like 2 or 3 the number of units in, at
uh,
X.
see, if there is continuous, I mean, if there is continuous derivation, it should give you the same values, right? I mean, in the basic sense, we are doing the same thing, right?
Yeah, yeah,
So you can do it by both manner. but it would be preferred that in terms of like, if you have to go by the basic definition, you go by derivatives.
Okay.
So, I mean, similar frame, if there is a question about profit also, it can be,
Yeah. So yeah. What about annual gross profit, sir?
okay. So, annual gross profit means you should know how many units are you producing in 1 year.
Yeah.
So, if you know that, okay, I'm producing X1 units, then by by this formula itself, you can get the gross profit, right? For that number of units. So, the only question remains is how many units are you producing?
But so in total cost, we have to take the derivative here also, or the equation that is given, we have to put as it is.
I guess in this case, you can put as it is. You won't have to put derivatives for gross profit now.
Okay.
Yeah.
Okay, sir. Thank you.
Okay. So, coming to the second part, a building costing rupees 16 lakh is expected to have a 35-year life with 25% salvage value. Calculate the depreciation charge for years 4, 9, 18, and 26 using straight line method, sum of years method, and double declining balance method. So, first of all, my question to you would be, what is depreciation and why depreciation?
Depreciation is nothing but change in the value of equipment over the years.
Okay, so change in value of equipment over the years. Let's suppose that I bought a concrete mixer today for 70,000. So next year its value will change by depreciation, right? But I already have the equipment with me. So does it matter if its book value changes? I mean, see, the value is changing. I'm not going to. The useful life for that concrete mixer for me is 5 years. So next year I'm not going to sell it. So next year I'm not worried about its salvage value or uh, what it would cost in the market next year. So why depreciation? I mean, it is still 70,000 for me, right? In terms of in today's cost.
Yes, yes.
So why depreciation? Yeah, you are in the basic sense you are correct that with over the time the equipment loses its value. So it might lose due to that, okay, it has been serviced that much, it has already given provided you service, or through functional obsolescence, or might be some other reason. So yeah, its value reduces. But if we are not selling, if we are not if we are not buying the similar equipment, or if we are not looking for its replacement, it doesn't give the logical sense to calculate depreciation, right, for each year. No, you would find that depreciation is quite helpful in taxation also, because government allows for it, that if you have bought something, I mean concrete mixer for 70,000, and after 5 years its value would be just 10,000. So government expects you to buy the new mixer next time, because it is going to improve or add on to the economy. So yeah, depreciation is there and it helps in maintaining the book value. Like if you know that how much it is depreciating, you can factor for it, uh, so that 5 years later when you are going to replace it, you know that from which year what kind of contribution you can expect. We will see all these things in the numericals part. So coming to methods of depreciation, straight line method, sum of years method, double declining method, double declining balance. Are there any other methods?
output or something of production method something
Yeah, units of
depreciation
production
method.
method.
Yeah.
Then there is one sinking fund factor method, right? Sinking fund method.
Yes, yes.
Okay, so initially we will be starting with these three methods: a straight line method, sum of years, and double declining method. So straight line method. This, as the name suggests, that uniformly the equipment's value is depreciating. So if your cost at time t is equal to 0, it's 16 lakh. At the end of 35 years, it would be 25%. So salvage value is equal to 1 by 4 of 16 lakh, 4 lakh. So over the period of time, 0 to 35, its value depreciates in a straight line manner as given by the definition. So the depreciation rate would be 16 minus 4 by 35, right? I mean, this would be the value, right? So by this amount, it would be depreciating each year. So it doesn't matter if we calculate it for fourth year or ninth year. I mean, fourth year, ninth year, 18th year, 26th year. Each year, it would be same 12 by 35, right?
Yes.
Okay. So coming to the next sum of years method. So the formula here is n minus t plus 1 divided by sigma n into p minus s. So what is happening is in this case is that we are assuming, or we are making the equipment depreciate faster in the initial years and slower in the later years. So for 35 years, sigma 35 is equal to 35 into 36 by 2, right? Just let me grab the calculator, and someone wants to join. Okay, do you have a calculator at hand? Can you help me in completing these values? Yeah, guys, do you have the calculator?
Yeah.
Yeah, so can you please help me in filling these values?
Sure.
So what we are doing is that we will depreciate the whole value of 16 minus 4, 12 lakh, in 630 parts, such that in first year we would be depreciating 35 by 630. In second year it would be 34 by 630, coming it to 1 by 630. So initially you can see that we are depreciating at a larger rate. So if you have to calculate at a specific point of time, like 4 years, 9 years, 18 years, so it would be uh, 35 minus 4 plus 1 by 630 into 12, right? By the formula that we wrote. So this gives you value around 60.95 thousand, and from straight line we saw that it was 12 by 35. point I mean 34.28 thousand constant. So initially you can see that our sum of years method gives us more depreciation than straight line, but let's check for 26 what is happening. Wait, uh, yeah, I wrote it like that. So in the 26 years, it gives a value of 19.04 thousand, but by straight line it was 34,000. So you can see that in later years the sum of years gives us less depreciation. Any issue till here? And this is the calculation part of it. So I guess if in exam you can calculate it for each of the given years in any condition. I mean straight line sum of years.
Yes, sir.
So can you count the similar values for double declining balance method? Please give it a try. Okay, so double declining balance. So that means your rate of depreciation becomes 2 by n, which in this case is 2 by 35, n being 35, right? So uh, 0.0571. Now for the fourth year, as you can see that it is not quite as straightforward as it was in the previous cases. What is happening is that book value at the end of depreciation for the first year is, wait a minute, okay, the equation we have is depreciation is equal to rate of depreciation into book value of the previous year. So even if we want to calculate it for fourth, we would have to calculate the book value of the third year, then and only then we can multiply, right? So let's try to simplify or simplify it in a formula. So if for the first year, right, year 1, your depreciation would be 0.057 into 16 lakh, not 12 lakh. We do not take care of salvage value in declining balance methods, right? So book value would be one minus your rate here into 16. For second year it would be into 1.057, wait a minute, 1 minus into 16, okay, because this is the book value in previous year. So this kind of gives you the formula that d into 1 minus d to the power n minus 1 into book value at time 0 for depreciation at time t is equal to n. So with this formula and putting the value of d is equal to 0.057 and b0 is equal to 16 and n as 4 4, 9, 18, and 26, we can determine depreciation. Yeah, depreciation charge at each year. So this becomes uh, okay. So I guess you can calculate this quite easily. So any questions related to depreciation methods?
So can you repeat that previous part of the two methods of how we can calculate at these directly?
For a straight line and
Yes, yes.
okay. Hmm. So in a straight line, okay, this page has become quite messy. Let me bring a new page here. Okay, so what is happening in the straight line method is that it is depreciating at a uniform rate, uniform rate, not rate, but uniform value, right? So each year it would be depreciating at 16 minus 4 by 35 lakh. So any beat any year, we will know the value. In case of uh, yeah, sum of years, sum of years, then it would be n minus t, or I mean, so for 4 you just put, I mean, you just put the given value here. N is 35 fixed, sigma n, you know, just put the value of t which has been given and you can determine it. And these are the depreciation charges. This is constant, right? You were asking for these only, right?
Yes, 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 sir.
uh, okay, so any other question regarding these methods? So while introducing, okay, we have got one more attender here. So sir, do you have any questions related to break even analysis? We covered that part quite fast in the first session, I mean in the initial session. Any questions related to break even analysis, please feel free to ask now. Okay, so moving forward with this, but before going into more depreciation calculations, we'll see some theoretical questions.
So, sir, I had a little query about the gross profit part. Can you
Oh,
explain it?
yeah,
The formula you said is gross profit is equal to revenue minus total cost.
yeah.
So, but the answer is I am getting something different. And what is the correct value is given over is 49, 4 lakh 95,000 something.
Okay, and you are getting a different value, but you are
Yeah,
using
yeah.
the same formula, right?
Yes, yes.
Okay, see, the formula for profit, gross profit won't be changing. It's been same since our fourth or fifth standard.
Yeah, yeah.
Like selling price minus cost price is equal to profit.
Yes, yes. This is it.
So if it is there, I mean, you can just message on the discussion forum so that we will look into it right then and there.
So once you can, I'll be sure. Then I'll surely do that.
Uh, okay, let me try if the portal is opening now.
So I can give you the data.
Yeah, no, portal is not opening. Yeah, but I hope you got the concept right. I mean, what to do in that case exactly.
Yes, sir. Yes.
And it might happen that the answer is not matching. We will look into it.
So later words or I had to put on discussion forum itself.
Yeah. Okay. So coming to some theoretical questions. In the context of different methods used to calculate depreciation of equipment over their service life, consider the following statements. Double declining balance method does not consider the salvage value of the equipment. Sum of years method of calculating depreciation yields rapid depreciation during early years life, and it also enables the asset value reduced to be zero. So which of the following are correct? I mean, we tried one numerical before. Same thing we did in break-even analysis. We tried one numerical, saw the graph, and then came to theoretical questions. So
The first one is correct, and second one half. I think I'll be sure. And what the zero value that I'm not sure about that.
okay, zero value you're not so sure about it. Now, can the salvage value of any equipment be zero?
No,
Why not? I mean, let's suppose you bought a green net for your site, for covering your site, right? And after 3 years in harsh sunlight, it is of no use at all. You can't even sell it as a scrap. So that means it can have a salvage value of zero, right?
yes, yes, yes.
So similarly, in the formula for sum of years method, or be it a straight line method, if you put salvage value is equal to zero, the calculation should bring the book value at the end of its service life to zero, right? If you are taking the consideration about salvage value, it should give you the salvage value at the end of its service life. So yeah, in sum of years method or be it straight line, yeah, you can get the asset value reduced to zero if your salvage value is zero. But in declining balance methods, we do not take care of salvage values. So yeah, we will get some value here and there till end, till the end. We would be reducing it by some factor. It would go on decreasing to a very small value, but still there would be some salvage value, or I shouldn't say salvage value, but the book value at the end of its service life, and it may or may not be equal to its salvage value. We will see it in one numerical. So yeah, this is true. This first part, you agreed that it is true. We saw it in numerical, and second part, it's also true. So both these statements are true. Now next, just true or false again. Straight line method, sum of years digit method, and declining balance methods are the methods to select construction equipment. Break-even analysis is equivalent to cost volume profit analysis. Price minus direct cost is known as contribution per unit. Break-even point is equal to indirect cost divided by contribution. So which of the following is false?
I
Third one
think
is
first
false, sir.
statement might be correct.
Which one? First one or third one?
Probably third one, sir.
Third one.
My answer would be first, I think.
Okay, so we have got two contenders. Mm, and as the problem is can be multiple choice, let's see. Straight line, these are the methods for calculating depreciation, right? Not to specifically select a construction equipment. So this is false. I mean, yeah, these help you in making the cash flow diagrams, uh, including taxation. So they uh, yeah, they can influence your decision, but these are not the methods. Second one, you agree that yeah, it's cost volume profit analysis. We have some cost, we want some profit, and the determining point is the volume. This break even point is indirect cost by contribution. We wrote the formula. So, and at that time, this term price minus direct cost of each unit is contribution. So that means third is also correct and fourth is also correct. So statement 1 is false. So next one, which of the following statements are correct in the context of declining balance method of depreciation accounting? It yields uniform depreciation throughout the service life. It yields greater depreciation in the early years, smaller write-off in the early years, or varying rate of depreciation is applied on the basis of market value of the asset. We have already discussed it at length. So what should be the answer here?
Option 2.
Option 2. Yeah. So I guess it is quite straightforward. Uniform depreciation, no. Uniform rate of depreciation, but the value is different. Yields greater depreciation, yes. A smaller write-off, no. It gives larger write-off. That's why we prefer it. Varying rate of
So,
depreciation, yeah.
so what is the difference between uniform rate of depreciation and uniform depreciation?
Uh, okay. So in coming to one, see, this is your straight line depreciation by straight line method, right? 16 minus 4 by 35. Now this is fixed for each year, so this is uniform. In case of double declining balance method, we were getting 2 by 35 depending on the book value, right? So the rate of depreciation is uniform. I mean, the rate by which it is decreasing, this factor is uniform, but the value is different. But in this case, in SLM, the value itself is same. Did you get the point?
Yes, yes.
Okay. So there is no varying rate of depreciation, and basis of market value of the asset. Yeah, we had a discussion on this also. Why not? So coming to a detailed question for this. Equipment tax is purchased at a cost of rupees 3,50,000. The income generated by the equipment is 2,50,000 annually for next 5 years. Yeah, you can see that it is quite lucrative deal. Calculate the rate of return post tax for this deal, and we have to do it by each of the three depreciation methods and have a switch over, prepare a cash flow for both pre-tax, post-tax. I mean, that is a quite detailed question. So we already discussed how to make cash flows, right? Why do we make cash flows? Anybody? Or why do we make cash flow diagrams? Guys, you will have to answer something. We have been making cash flow diagrams since the starting in this course. Almost starting.
So it just helps to understand the cash inflows and cash outflows.
Yeah. I mean, it just gives you psychological advantage, right? I mean, you
Yes, yes.
can look at it from the Excel sheet also, but yeah, it gives you the visual representation. So let's make the cash flow diagram initially. So what is happening is that our time period is 5, right? 0 to 0, 1, 2, 3, 4, 5. At 0, we have got 3,50,000 as a payment, right? 350. and for each 5 years we have got annual return of 250 each year. So this would be your pre-tax cash flow, right? Or will there be any change? I mean, now you guys also know about time value of money. So simple question is, will it change or will it be the same? Okay, you guys think about it. We will start working on depreciation. So the first thing is a straight line method of depreciation. Uh, there is no salvage value, so we will take it as 0. So that means 3,50,000 minus 0 in 5 years, 70,000 each year. So let's make the table for it. Book value at m minus 1, depreciation, and book value at m. In this I will keep it as m. So 350, 70. So your depreciation book value becomes 280, 70, 210, 210, 70, 140, 70, and then 70, 70, 0. Right? Any doubt about this table? What we did or what values we got? And that's just straight line. Any doubt, any question? So let's do one thing. Let's calculate the depreciation for each year. Let's make the depreciation table and then we'll go into tax part. Sorry, it seems my network got dropped. So, can you guys tell me where I was before I lost you guys? You guys are still here, right?
Yes, sir. So you have drawn the cash flow diagram.
Only cash flow diagram. We didn't start in for depreciation.
No, no.
Okay, that means I've been gone for long now. Okay, so this was the cash flow diagram. Any question on this part? I mean, you guys agree that this cash flow diagram is correct, right? So we will move forward. So, coming to the, I'll again solve for this straight line method. Your depreciation here is, your present value is 3,50,000, salvage value is 0, and time period is 5. So that means each year the depreciation is 70,000. So let's calculate it. So this is book value at the end of previous year or book value at the starting of this year. I mean, let's say your financial year is from April to March. So book value at the end of 31st April would be the same as book value at the start of 1st April, right? And 31st March to 1st April, it would remain the same. Your year is changing. So just calculating it. So this comes here 280, depreciation is 70, it is straight line. So 210 minus 70, 140, 140 minus 70, 70, and 70 minus 70, 0. We saw this in case of theoretical question also, that yeah, if salvage value we are assuming it to be 0, we can bring the book value down to 0, right? Any question on this part? What we did and making this table? Okay, no question here. So first calculating the depreciation, straight line method, it's done. For sum of years, we have got 350 only and 5 years. So for the let's see what rate we get. 1 2 3 4 5. Book value at the starting is 350. BM minus 1, your DAP M. What is depreciation in the first year? I would write it as 5 by 15 into 350, right? Will it be this value? Anybody?
Not sure about that.
Okay, not so sure. Okay, so we'll go back to the formula. The formula was n minus m plus 1 sigma m into p minus s. So p is 3,50,000, s is 0, n is 15, sorry, n is 5, and m for the first case is 1. So for d1 it becomes sigma 5, which is equal to 15 into 350, right? And
Yes.
yeah, and for d2 this 1 will be into 2. So similarly, if we find out the values, this would be 116.67. Similarly, without even calculating the book value, we can determine this. I mean, instead of 5, it would be 4 for year 2. Right?
Yes.
So 93.33. For third year, it would be 70. For next year, it would be 46.67. And for the last, it would be 23.33. Now let's calculate the book values. So can you do it quickly? So this becomes, I guess, 233.33. This similar, it will come to this point, 233.33 minus 93.33 again. This would bring us to 140. 140 minus 70, it would be 70. 70 minus 46.67, it would be 23.33. And so you see that sum of years of digit method also gives you 0 book value if your salvage value is 0, right? So are you getting the same table? Do try to make it, or have I done any mistake here? So are you getting the same table?
Yes, sir.
Okay. So now what is remaining is that we go to the next method, and that is double declining balance, right? So for DDB, our factor would be uh, it is double declining balance. So rate would be 2 by n. Here 2 by 5 is equal to zero point 0.4, right? So m BM book value at the end of or at the start of first year, depreciation in that year, book value at the end of that year. So here it would be 350. Depreciation is zero point 0.4 times. Zero point 0.4 times of what? Zero point 0.4 times of this value, right? Right or wrong? I mean 0.4 times of this value. So instead of having book value here, let's mm, 2 by n is zero point 0.4. So depreciation would be 140. So book value at the end of this year would be what would it, 210, right? So 210 again, zero point 0.4 is the rate. Are you following me till here?
Yeah.
Yeah. So this would be 84. Uh, this value becomes 126. 126. Again, the rate is same. So 126 into 0 0.4, it's 50.4, and this becomes 76. No, 75.6. 75.6 into 0 0.4, that is 30.24, and 30.24, that means this remaining value is 45.36. Okay, so 45.36 into 0 0.4 is 18.14. So this becomes 27.22, right?
Yes, yes.
So as you can see that we are getting some value here, but
Yes.
in the previous two cases we were getting book value as 0
Yes.
at the end of its useful life. So what to do now? And is it a problem? I mean, you tell me, if you're getting some book value at the end of its useful life, and you know that its salvage value or scrap value is 0, and yet you are getting some value here. So is it a problem? Is it an issue?
Yes, sir.
Why?
So because in accounts book, the actual value might be zero.
Okay. So no, see, this is your accounts book, what you have calculated here. So in accounts book, you are showing that its book value is 27.22, while its value for you right now is 0. So this means that you have a loss of 27.22, right? Do you get my point? I mean, in your books, you are showing that you have a asset which is worth something, which is worth 27 at the end of 5 years. But in reality, it's worth 0. So that means you have a loss of something, right? You have the loss of that value. Are you getting my point? Okay, yeah, sure. So yeah, why should book value at the end of 5 years, in which in this case where we have been given that salvage value is zero, why should it be a zero? I guess you got the idea that okay, if this is different, and how it how it is perceived, so it is not coming to zero. How can we make it zero? Or if our salvage value is not equal to the book value at the end of our service life, how to calculate for that? So in this question we have been provided that you can use a straight line method of depreciation in case there is a need of switching over and double declining balance method. So you can see, yes, that there is some need, you have to switch over, and switching over they have given you the method, straight line method. Why switching over? So that it makes better sense to us. Now the question arises, when do we switch over? Okay, let me write it. Switch over. What is happening here is that you want this value to be equal to 0. It is not coming by double declining balance method. If you go by any of the previous methods, sum of years method or SLM, you are getting it at 0. You want it to be 0. So you would be like, oh, I would go by the previous methods only. They are giving me 0. But your reason for picking this method was that it gives you a very fast or higher rate of depreciation in the early years. As you can see that in the first year it is depreciating by 140, while in case of sum of years it was 116, and in SLM it was only 70. So yeah, you know that we prefer DDB, but if it is not giving us the value that we want, we are allowed to make a switch over. Now when do we switch over? And switch over to SLM. So we switch over to SLM where the depreciation by SLM is more than depreciation by DDB. I mean, we are following DDB because it is giving us DDB DEP is less than SLM. We switch over, right? We are following DDB because it is giving us better depreciation. So let's find out when to switch over. Okay, DEP by SLM. So in first year, if you have to depreciate 210 to 0, you would say, okay, not 210, 350 was our book value. So 350 by 0, 350 to 0 in 5 years. So that means we have to depreciate by 70 in this year, or 70 throughout. Do you get this point? What is happening? Okay, if you get this clearly, I will move forward with this. Let me check if there is something. No. Okay. So here this 70 is less than 140, right? So we will be picking this only. We will be going by double declining method only. Now for the next year, the book value is 210, and now only in 4 years, right? 2, 3, 4 and 5, you have to bring it to 0. So what by SLM, what would be your value? 210 by 4, right? Any confusion here? 52.5. Now let's compare it again. So this is again less than 84. So we will move on with double declining balance method. For the next case, 126 by 3, 42. and it is less than 50.4 that you are getting in DDB, right? So again you will be moving on with double declining balance method only. Now for this year you have got 75.6 by 2. So what value are we getting? 37, yeah, 37.8. Now you can see that this 37.8 is greater than 30.24 by double declining balance method. So we will be picking 37.8. So at the end of year 3 we will be switching over to straight line method. So you saw that if you check for checking also, you can go directly by, you can only check after n minus n by 2 years, because your switchover will lie in the second half only to n. So we could have skipped checking for first and second year. Yeah. So here you are getting that, okay, you can depreciate by straight line method. So let's do that. So for year 4 and 5 I'll rewrite. Any confusion till this part what we are doing? Okay, if not then I'll write it for year 4 and 5 again. The book value at the start of 4th year is 75.6. Depreciation is by SLM, it is 37.8. So the book value at the end of 4th year becomes 37.8, and for the 5th year 37.8 is your book value at the starting, depreciation is 37.8, and book value becomes 0. So we did switch over. At the end of 3rd year, so any confusion in this part? How to do the switchover? Why are we doing the switchover? And how to calculate the values after that? Guys, I will need your response before proceeding ahead. You can hear me clearly, right?
Yes, sir. Yes, sir. Please proceed, sir.
So this point is clear, right? What is happening? Why did it happen?
Yes, sir. This is clear.
Okay. So by each of these methods, we calculated the depreciation. But our question was that we have to calculate the rate of return post tax. So we have to move on towards the tax calculations. Now coming to SLM, this is our depreciation 70. What is our annual earning? What is our annual income in this case? It is given to us, right? 2,50,000. And depreciation, here I would write it in bold. Depreciation expense is 70,000. So that brings our net taxable income as how much? 1,80,000. And our tax rate is 50%. So tax at 50% is equal to 90,000. So that means our net income is equal to 1,60,000, and this will be the same for each year because our annual income is fixed, our depreciation expense is also fixed in this case. So this brings our net income to 1,60,000. What would have happened if we didn't consider this depreciation? Our annual income would have been 2,50,000. So 50% gone in tax, 1,25,000 would have been gone, and our net income would have been 1,25,000 only. So post tax cash flow, right? So initially we have got 350 lakh at time t is equal to 0, and for next 5 years we are getting 1,60,000 each year, right? Do you guys agree about this cash flow? Post tax cash flow, you saw how we draw it.
Yes, sir.
So can you calculate? Okay, I'll go back to the question. Our question also asks for determining the rate of return. So can you determine? Can you find the rate of return in this case? Or how will you determine the rate of return in this case? We already studied it. Yeah, I mean, how we have got cash flow. So how do you determine the rate of return? Anybody?
Sir, should we try NPV, net present value of all the annual incomes, and then take the difference of both, calculate how much percentage we are getting?
Okay. Yeah, but at what I will you start your calculations? I mean, this looks like a trial and error method, right?
Yes, sir. Yes, sir.
So let's try to calculate it. So what would for determining I, we have to go by trial and error method. What we have is uh, at the internal rate of return, your NPV should be equal to 0, right? And here what do we have is 1,50,000, 1,60,000 P given A, I comma 5 minus 350 is equal to 0. So with what I should we start? Let's say I is equal to 20%. I mean, we can start with any value, right?
Yes, sir.
So how much is it coming? Let it be in terms of 1000 only. So at I is equal to 20%, our NPV comes. Can you guys calculate it? It comes around 128,500. It is positive. So let's increase, and it is a big number. So let's increase by 10%. At I is equal to 30%, this comes to be 39,700. Again positive. So let's try it I is equal to, but it is a smaller value now. So let's try it 35%. You guys can follow these calculations, right?
Yes, sir.
It is 5200, again positive. So smaller value, let's take it I is equal to 37%. Minus 7200. Okay, so we have got two values quite close. So our I must lie somewhere here, that we can determine by interpolation, right? Can we do that? Can you guys tell me the I now after interpolation? Okay, first of all, tell me, did you get the idea of what is happening?
Yes, sir.
Okay, so you will get some rate of return here. And this sort of solves our first part, straight line method. We made the cash flow, I mean pre-tax, post-tax cash flow, and we determined the rate of return. So now going to the next part, sum of years. So again we have to make the cash flow. Cash flow means determining what is our taxable income for each year. As you can see that now it will vary, right? For year 1, if you see, your earnings is 2,50,000. Your depreciation expense are 1,16,667. So your net taxable becomes 1,33,000, right? 333, and it's taxed at 50%. So that is again 67,667. Now, so what is your net income? Net income at the end of first year, 1,83,000, right? So if you make the cash flow, you have got 350 here, and okay, let's make it 1 here and 2 here. So this becomes 183 point. Any confusion on this part? What did we do? I mean, I just repeated it. Okay. Any confusion? What happened? Okay. So similar calculations you have to do for each year. Now tell me what is the for year 2 what will happen. Year 2 you will say 250 is your income, minus depreciation expenses 93.33. So that gives your net taxable as 150 156.67, right? Am I doing it correctly? Guys, are you solving it with me? I will need some response here.
Yes, sir.
Okay, so have you followed till here?
Yes, sir.
Okay, so this becomes tax is 78,000. Now see your tax liability has increased for next year. So net income becomes 250 minus your tax, whatever you're paying, right? 171.67. So this arrow should be a little bigger and a little small. I mean, visually we should be able to identify. So 171.67. So similarly, you have to calculate values for each year. Can you guys do that? So once you do it, you would find that at third year you have got 160, at by fourth year 148.3, and 136.67. Okay. Uh, are you guys calculating? Should I give you some time to do
Sir,
it? Yeah.
sir, I have one doubt in assignment 3.
Okay.
Question number 4.
Okay. You are not getting the value that is given in the option, right?
हाँ,
Uh, okay, she just dropped from the call. Okay, so I'll give you guys a couple of men. Yeah. So for others, I would request you to please try and match. I mean, are you getting the same cash post-tax cash flow?
हेलो सर.
Yeah, ma'am.
हाँ सर, सॉरी डिस्कनेक्ट हो गई थी.
No issues. So
हाँ सर.
yeah, you are
Sir, can you explain me that sum?
uh, okay. So let me finish this part. I mean, it would,
Yes sir, sure sir, sure.
yeah. So are you guys getting the same post-tax cash flow? Are you trying it or not? Okay. So with this, you know by trial and error method how to find out I. For double declining balance method also, you have got depreciation. Right, let me highlight it. You have got these values for each year. So you know how to calculate it. Like, should I calculate the values? Anybody? And this is supposed to be an interactive class, right? Okay, so I will start calculating. Year 1, we have got uh, income before tax, right? or I would say uh, earnings before tax. Let it be income only. So we have got 250, right? This hasn't changed. Your depreciation expense in first case is 140. So net taxable income becomes 110. Tax at 50%, it 55. So net income is 250 minus 55, 195, right? So let's have the cash flow. 350. At the end of year 1, you have got 195. What about year 2? Income is again 250. Depreciation has reduced to 84. So net taxable becomes how much? 166, right? So taxing this at 50%, it becomes 83. So net income is 167. Yeah. So we calculated the values for year 1 and 2 for each case. Let's just compare it so that we can have some interpretation from there. In case of DDB, net earnings is 195 in year 1. In sum of years it is 183, and in a straight line it is 160. So you saw that when you have got more uh, depreciation or more value of depreciation coming, you get the benefit that your taxes also saved, and similarly your net income increases. But if you go on calculating for each year, you will find that the total value remains the same. Okay, so I would I hope you would I hope you would try this question on your own. This is a complete question and gives better understanding of each concept. Yeah, so coming back to your doubts, any doubt, any question? Yeah, we'll come to the assignment problem. Okay, so the assignment problem was of break-even analysis. The total cost is equal to indirect cost plus direct cost. What is indirect cost? That you can't specifically assign to any unit, right? You cannot assign to any unit. It is kind of fixed that even if you produce some thing or not, you are going to incur these indirect costs. That can be your establishment, overhead charges, anything. So for direct cost, you can also write that direct cost is equal to n times of unit direct cost, and one direct cost of one unit into the number of units produced. And what would be your price would be what would be your earnings, or I would say, yeah, what would, so total selling price would be n times of price of one unit, right? So for break-even analysis, we need to find the minimum number of n, so that the so that we are not in loss. That means your selling price minus cost price should be equal to 0, right? You get this idea? So NP is equal to IC plus N into UDC. So at break even point, N is equal to IC by P minus UDC. Is this clear? Okay, so now let's see what is happening. This is some, this IC is quite fixed. I mean, is fixed, and this direct cost, it is in terms of N. Now here it was chosen as linear, but it can be any power of N. So and similarly your selling price is also in terms of N. So what is your profit? Profit formula remains the same, SP minus, I mean selling price minus cost price. So NP minus IC plus DC. Right. Now this total cost, this equation can be given to you in any form. Now from this, if you want to calculate the profit, it's simple. You put the value of X in both total cost and selling price and find out your gross profit. So what is your exact doubt in this case? I mean, this is what you have to apply, be it any equation in N or X.
हाँ सर, ये क्वेश्चन मुझे समझा ही नहीं था.
Okay. So have you got an idea now? Okay, let's try to add some values. I mean, this was the first example we discussed in today's class. Your IC is 40,000, UDC is 1500, and P is 3500. Okay, so let's say that you have to produce 30 units. For 30 units, if I asked you what is the total cost, you would say it's 40,000 plus 1500 into 30, right? 85,500. No, sorry, 85,000. Have I done any calculation mistake here? I don't think so. Okay. And selling price would be right. So if you were to find out the profit, you could have found out here also directly. But if we were talking only in terms of variables here, so what we did is, okay, 1 minute. Are you guys following me till here? I mean, I just did some calculations. I just put the value of X is 30. Now what I will do is I will put the value of X is 31. 31, you will see that the total cost now is 40,000 plus 1500 into 31, right?
Yes, sir.
86500. So in for 30 units you are spending 85,000. For 31 units you are spending 86,500. So for producing the 31st unit, your marginal cost is TC at 31 minus TC at 30. Right. Now this is when we have some values and we go on assuming, we do the longer calculations, or the same thing could have been done by the by calculus also. Like you have got this TC, total cost is equal to IC minus IC plus n times UDC, or let's come back to this equation only what we have been talking here. In this case it would have been 40,000 plus 1500x. So you want the change in total cost per unit x. So all you have to do is you have to derivate it once. So by that you will get that change in TC per unit x is 1500, and that gives you your marginal cost. I guess this is similar to the question in the assignment, right? So calculating the marginal cost, calculating the gross profit. I hope it is clear now.
Sir, can you explain the same problem which is given in the assignment?
Uh, okay, that kind of is. Uh, Actually, I've been trying to open the same page. I can't. The Swayam website is not loading today. Okay, it is there. It is loading now. Just give me a moment.
Sir, I also have doubt in assignment 2 and 1. Can you explain it?
Yeah. Okay. We can. Yeah, we'll see those questions also. So
Thank you, sir.
yeah. In this question, you can see clearly that. Okay. Uh, let me see. Okay. So you have been given per unit cost, and you have been given unit selling price, right? So UDC has been given to you as 1 lakh, and total cost has been given to as 50,000 plus 500 by under root n, right? So marginal cost for producing 50th equipment, either you can calculate it till 49 and for 50 and subtract it, or you can do it by calculus. Similarly, in the second, what is the gross profit if the company sells 100 pieces of the equipment in a year? So for 100, you just have to put the value of n is equal to 100 and calculate total cost till then. I mean, that is a straightforward question like this only.
सर मीन्स एन का वैल्यू 100 सिर्फ वो टीसी में डालना है क्या टोटल कॉस्ट में?
See here, the mm, n का value 100. No, you have to integrate it till then, because उस क्वेश्चन में हमें पर यूनिट दिया हुआ है, टोटल कॉस्ट नहीं दिया हुआ है, हमें पर यूनिट दिया हुआ है. सो आप एन की वैल्यू 1 रखोगे तो फर्स्ट यूनिट का कॉस्ट आएगा, 2 रखोगे सेकंड यूनिट का कॉस्ट आएगा. सो यू हैव टू इंटीग्रेट इट फ्रॉम 1 to 100. So then you will get the total cost for 100 units. So any conceptual doubt regarding week 1, week 2? I mean, questions I can discuss right now also. The conceptual part definitely. So till week 3, any doubts or any doubt from this session?
Okay, I want to ask just one question.
Yeah.
When we switch over the method, if we are getting the higher values,
Yes.
did you get the part where I am asking from?
Yeah.
Sir, why do we switch from the next step? Why not for the same step only? When we know that this is coming on the higher side, then why can't we switch over that step only? Why we do
Yeah.
for the next step?
Okay. So here this was the switchover point, right? Uh, so see, for the third year, if you calculate the depreciation by a double declining balance method, it is coming 50.4, right?
Yes, sir.
I mean, this you can follow 50.4.
Yes. Yes,
But
sir.
for the third year, if you calculate it by straight line method, 126 by 3, it is coming 42. So it is less than
Yes.
50.4. So for third year also, you will go forward with double declining balance method.
Why, sir?
Coming
Why can't we switch over only on this step only?
because our depreciation by SLM is less than DDB. See, we saw in Texas also that if you have more value of depreciation, you will get better tax benefit, right?
Okay. Okay.
So
Mm-hmm.
what we are looking for is that our depreciation should be higher on the higher side.
Okay, sir. Okay.
So here in this case, at the end of third year, we are getting more depreciation by double declining balance method and less by
Okay,
SLM.
sir. Mm-hmm.
So we will be moving forward with DDB. Now, when we check for fourth year, by DDB we are getting 30.24, and by SLM we are getting 37.8. Now, this value is on the higher side. So we would prefer to have this value, right? I mean, the higher depreciation.
Right, sir.
So we took this for the fourth and fifth year.
Okay, sir. Okay. Okay. Got it, sir.
Yeah. Okay. Anything else?
No, sir.
Okay. So anything related to the topics in week 4 or previously that I should repeat? Okay, so this brings us to the end of this session. Thank you guys. Thank you for attending. See you next week, same time slot. Thank you.
Thank you, sir.